How is sustainability reshaping the commercial real estate landscape, and why is it now considered a strategic imperative rather than just an aesthetic choice? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In today's episode, we're diving into an insightful piece by Ashish Bhutani, who explores the evolving role of sustainability in commercial real estate development, particularly in India. Once defined by just square footage and skyline dominance, India's commercial real estate sector is now being reshaped by deeper, more enduring forces, chief among them, sustainability. The anticipated market expansion in India is staggering, growing from 49.30 billion United States dollars in 2025 to 128.40 billion United States dollars by 2030. However, the most consequential developments may not be those that are tallest, but those that are smartest and greenest. This shift in focus is becoming evident as office leasing activity across key urban centers recalibrates. While cities like Bengaluru and Hyderabad lead in terms of sheer supply, accounting for 28% and 23% respectively, Delhi NCR has made one of the most notable comebacks. It recorded a 133% surge in new office stock, growing from 2.7 million to 6.3 million square feet in just a year. This rise is not just a reflection of pent-up demand, but of a more deliberate approach to building for the future, integrating environmental efficiencies, flexible layouts, and wellness-focused infrastructure. This shift is driven by an evolving ecosystem of stakeholders. Tenants today, especially multinational firms, are aligning real estate decisions with environmental, social, and governance goals. Investors are prioritizing green-certified buildings in their portfolios, and regulators are tightening compliance frameworks. In this new reality, sustainability is not an aesthetic choice, but a strategic imperative. In response to this demand, contemporary commercial hubs are being engineered with efficiency at their core. Innovations such as rainwater harvesting systems, solar integration, energy-efficient HVAC mechanisms, low VOC materials, and intelligent building management systems have become standard expectations in next-generation office spaces. These measures aren't just good for the environment. They make business sense by translating energy savings into lower operating costs and boosting employee satisfaction and productivity. Cities like Chennai and Ahmedabad have witnessed significant year-on-year growth in gross office leasing, with Chennai recording an 82% increase and Ahmedabad experiencing a fourfold rise. Demand today is linked less to location alone and more to the quality and foresight of the built environment. Green certifications, once viewed as vanity badges, are now baseline requirements for serious developers. Projects certified by the Indian Green Building Council, or GRIHA, are increasingly viewed as lower-risk assets, especially in institutional deal-making. Delhi NCR's newer projects are leading the charge here, proving that even in dense urban corridors, responsible construction can thrive. Furthermore, some developers are extending sustainability beyond construction practices, embedding it into broader corporate responsibility frameworks. Initiatives focusing on environmental conservation, education, and animal welfare reflect a holistic approach to sustainable development. These multifaceted programs underscore a commitment to building not just sustainable structures, but resilient communities. What sets certain developments apart isn't just their adherence to green norms, but the integration of sustainability at the design and systems level. From dynamic lighting that adjusts to occupancy, to intelligent climate control that optimizes indoor air quality while reducing energy draw, commercial buildings are evolving into responsive ecosystems. More importantly, sustainability is being embedded at the planning stage, right from material sourcing and construction waste management, to passive design strategies that reduce heat gain and energy load. This kind of thinking isn't just progressive, it's protective. In an era of rising energy costs, unpredictable climate events, and changing workforce expectations, sustainable buildings are emerging as resilient assets. As the sector prepares for a phase of hypergrowth, the risk lies not in growing too slowly, but in growing irresponsibly. For regions like Delhi NCR, where infrastructure is already under strain, the opportunity to lead India's sustainability evolution is both urgent and immense. Commercial real estate is no longer just about developing assets. It's about shaping urban futures. The world's largest commercial real estate services firm, CBRE, expects United States office conversions and demolitions to outpace new construction for the first time in years. This marks a significant shift in the industry, as the conversion and demolition of office spaces have not surpassed new construction since at least the year 2000, according to an executive from CBRE who spoke with CoStar News. In a report set for release, CBRE highlights that this trend may help reduce the national office vacancy rate, which is hovering near an all-time high of 19%. Their analysis of 58 major U.S. markets indicates that 23.3 million square feet of office space is designated for demolition or conversion by the end of this year, while developers plan to complete 12.7 million square feet of new office space. Julie Whelan, CBRE's head of occupier research for the Americas, noted that this trend might hold in the near term, given current market conditions. New office development faces similar challenges to conversion projects, including elevated interest rates and higher construction costs. The demand for high-end office space is pushing obsolete offices out of the market, with 64% of conversions occurring in central business districts. Phil Mobley, CoStar's National Director for Office Analytics, pointed out that while conversions are happening at a higher rate, they remain rare as a share of total inventory. They can transform specific areas, but typically involve office buildings that were not competitive in the leasing market. The Dallas-Fort Worth area, for example, ranks 5th in the U.S. for office space in the conversion pipeline, with projects like the Sinclair showcasing the shift from traditional office use to mixed-use developments. Cities like Manhattan, Washington, D.C., and Houston lead in the amount of office space undergoing conversion. Programs such as New York City's zoning reforms and Washington, D.C.'s Office to Anything initiative are spurring these redevelopments. Cleveland stands out for having the highest share of its office inventory, undergoing conversion at 8.4%. CBRE's report also notes a decline in office construction completions, dropping from 51.2 million square feet in 2018 to an expected 12.7 million square feet this year. The firm highlights that 81 million square feet of office space is in the pipeline for conversion to other uses, with apartments playing a dominant role in these projects. This shift reflects a broader trend of adapting to the changing demands of urban environments. Seattle's office sector has experienced a significant downturn in 2025, as reported by Vicente Fusea. The transaction volume in the metro area fell sharply compared to the previous year. Commercial Edge data reveals that year-to-date through April, Seattle's office sales volume reached $136 million from the 9 properties that were traded. This is a substantial decline following a robust 2024. The metro's pipeline also saw a reduction, shrinking from 3.3 million square feet last year to just 814,824 square feet in April. The vacancy rate increased to 27%. A 400 basis point jump from the previous year. Despite the challenges in sales and pipeline, Seattle's listing rates saw an increase, averaging a 5.4% rise year over year to reach $39 per square foot. However, when compared to the national average, Seattle's pipeline is slightly below the national threshold, with only 0.6% of its total stock under construction. This is in stark contrast to cities like Austin, which leads nationally with 10.6%. One of the city's largest projects is Amazon's Bellevue 600, which will add more than 1.5 million square feet of office space to the city's inventory. This development is scheduled to come online later in the year. Another significant project is Dune Real Estate Partners 4106 in Bellevue, Washington, a 484,700 square foot office building funded by a $270.5 million loan from Blackstone Group. These projects highlight the ongoing development despite the overall slowdown in the sector. Seattle's office sales volume through April was $136 million, a decrease of nearly one-third compared to the same period last year. Assets in the metro traded for about $120 per square foot on average, which is significantly lower than the national figure of $191. Among peer markets, only Chicago had a lower average price per square foot, while Manhattan continued to lead with $439. The office vacancy rate in Seattle reached 27% by the end of April, which is considerably higher than the national average of 19.7%. San Francisco is the only gateway metro with a higher vacancy rate at 29%. Notably, the market's listing rate in April was $39, slightly above the national average of $33.3. Amid these challenges, Seattle is also seeing a trend towards office to multifamily conversions. The Seattle City Council passed legislation in February to ease the conversion of vacant office buildings into housing. This initiative is part of the city's broader effort to address underused office space while increasing the supply of much-needed housing. The coworking sector in Seattle remains steady, with more than 3.2 million square feet across 156 locations. This represents a slight increase from the previous year. Seattle's coworking space accounts for 2% of the total inventory, which is on par with the national average. Regus leads the coworking providers in Seattle with 530,156 square feet across 26 locations, followed by WeWork and Extra Slice. Orion Real Estate Group, based in Miami, has purchased the Posner Commons shopping center in Davenport for $63.5 million. This transaction was brokered by Collier's retail investment team, consisting of Brad Peterson, Whitaker Leonhardt, and Eric Amorine. Posner Commons is strategically located near the intersection of Interstate 4 and US Highway 27, serving several communities including Davenport, Champions Gate, Winter Haven, Kissimmee, and Orlando. The shopping center, built in 2008, has become a notable destination for both residents and tourists. Key tenants of Posner Commons include Dick's Sporting Goods, Ross Dress for Less, PetSmart, Michaels, JCPenney, Cinepolis IMAX Theater, Davenport Ale House, and Best Buy. Notably, Target and BJ's Wholesale Club, although situated within the complex, were not part of this sale as they are independently owned. The transaction also includes a 6.2-acre undeveloped lot slated for a new, expanded Ashley Furniture store, which will be developed by Sembler. The proposed store will encompass 60,887 square feet, more than doubling the current Ashley Furniture space at Posner Commons. Orion's acquisition highlights the appeal of retail centers with high-performing tenants and the potential for further development, especially given the substantial residential growth in the area since the shopping center's inception. With over 200,000 cars passing daily on adjacent highways, the location benefits from both local and tourist traffic. The sale of Posner Commons is the largest shopping center transaction in the Orlando Metropolitan Statistical Area so far in 2025. Colliers has been active in the area, recently brokering sales of other notable shopping centers such as the Marketplace at Seminole Town Center and Lee Vista Promenade. JLL Capital Markets has successfully facilitated the sale of an industrial portfolio that spans 3 key markets: Denver, Houston, and New Jersey. This transaction involved 10 high-quality industrial properties totaling 2.1 million square feet. JLL represented a confidential seller in this deal, with Principal Asset Management and a state-sponsored pension plan acquiring the assets. The portfolio boasts a 96.7% occupancy rate and comprises 5 properties in Denver, 4 in Southwest Houston, and 1 in northern New Jersey. These properties are strategically located in high-growth markets, offering modern features such as an average building size of 210,000 square feet and an average clear height of 32 feet. In Denver, which accounts for 56% of the portfolio's square footage, the assets are strategically positioned between the airport and downtown. This location capitalizes on the city's growing logistics needs, with properties like Mile High Industrial 1 at 11,700 E, 47th Ave, and Mile High Industrial 3 at 11,351 E, 45th Ave, highlighting the strategic positioning. The Houston properties, making up 34% of the portfolio, are well positioned in the southwest submarket. Meanwhile, the New Jersey asset, located at Exit 8A of the New Jersey Turnpike, offers excellent access to the Northeast Corridor, underscoring its strategic importance. The JLL Capital Markets investment sales and advisory team included several senior managing directors and industrial group leaders, demonstrating the high level of expertise involved in this transaction. The team noted that this portfolio transaction underscores the continued favor that high-quality assets in strategic markets enjoy with investors. JLL Capital Markets is a full-service global provider of capital solutions for real estate investors and occupiers. Their in-depth local market and global investor knowledge enable them to deliver best-in-class solutions for clients, whether it is investment sales and advisory, debt advisory, equity advisory, or recapitalization. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.